Hello, this is Books of the Stock Market. How's everyone doing? As for me, I looked at my calendar for the rest of the year and I saw that January 18th will be the last company holiday for a while. I think the next company holiday is on May 31st, which is too far away. Other than that, I started the new video series and I think I might be overworking myself. I have to work on it every day since I have to be up to date with the news. Also, editing those videos take a lot more time. The book summary videos I can usually finish in 1 to 2 days and I can make a bunch of them at once. The Sunday report, however, I need to work on it weekdays after work and edit the video on Saturday. Hopefully it becomes less time consuming once I get used to the process. Now, let's get into today's topic. In part 2 of a 3-part series on oscillators, we'll be talking about RSI and Stochastics. If you have not watched part 1 of this series, you should watch it since I don't really go over the basics. I'll link that video in the comment section below or click the I button on the top right corner of your screen. So in the last video we talked about momentum and how to use it. However, there are a few problems with momentum as with all indicators. The biggest problem with momentum is that they can be very erratic as they consist of sharp peaks and troughs. So what is the solution to this? The solution is to increase the amount of days or to smooth it. We will talk about the RSI, which does do the necessary smoothing to get rid of those volatile peaks and troughs. As mentioned briefly in previous videos, the relative strength index is an oscillator that tells if the stock is overbought or oversold. The RSI formula is shown here. The only complicated part is RS, which stands for the relative strength. The relative strength is calculated by dividing the average of X days up closes and the average X days down closes. X days up closes mean the total amount of points gained on an update divided by the X amount of days or weeks. The usual amount of days or weeks is 14. On the other hand, X days down means the total amount of points lost on down days divided by X amount of days or weeks. Now that we know how to calculate the relative strength index, let's cover 2 points before we get into some examples. First, like most oscillators, the RSI's time period can be adjusted. If a shorter time period is used, then the more sensitive the oscillator is and the wider its amplitude becomes. A wider amplitude means higher peaks and lower troughs. Second, once again like most oscillators, the RSI works best at extremes. So what are the extremes of RSI? The higher extreme is usually 70 and anything above that is considered overbought. The lower extreme is usually 30 and anything below that is considered oversold. In bull markets, 80 is considered overbought as uptrends can lead to more extensions. In bear markets, 20 is considered to be oversold. Let's look at an example. This is SPY on the daily time frame. Here we see that we are at the upper extremes of the RSI. Shortly after, we see that price dip due to this overextension. Likewise, we see another overextension above 70, and we also see price dip to these levels. Finally, we see that the market became really overextended here, and this causes price to correct this overextension by dropping. Now that we know how to read the RSI, let's look at a more complex topic. Failure swings happen when the RSI is above 70 or under 30. A top failure swing is when the RSI does not make a higher high in an uptrend, so there is a divergence between the price moving higher but the RSI moving lower. This is usually considered as a topping pattern or at least signals a provisional top. A bottom failure swing is when the RSI does not make a lower low in a downtrend. This means that there is a divergence between price moving lower and the RSI moving higher. This is usually considered as a bottoming pattern or at least is considered as a provisional bottom. Let's now look at an example. This is the IWM on the 4-hour time frame. Here we see that price makes a higher high. However, the RSI does not make a higher high. Since it makes a lower high, this is considered to be a divergence. This causes the price to drop. So how do we stitch this all together? From what I've explained, we know that the RSI is very useful when trying to determine the top or bottom. However, timing the top or bottom is usually not a good strategy, so to make sure you don't lose all your money, these 3 steps must be followed. First, just take note when things get overbought or oversold. Don't immediately buy or sell things as things can change very quickly. Second, wait until the top or bottom failure swing occurs. Finally, you have to watch if the RSI goes back below 70 in an uptrend or above 30 in a downtrend. Before we move on to stochastics, let me go over 3 points. First, the RSI should be used when the stock is overbought or oversold. However, you should be careful and not immediately jump into a trade just for the sake of it being overbought or oversold, as a strong trend can leave prices at overbought or oversold levels for a long time. Although I don't do this and only use the RSI when we hit the extremes, but some people use the midpoint line as a support level during pullbacks and resistance levels during bounces. From here on out, we'll be talking about stochastics. Stochastics uses the concept that as price rises, closing prices tend to be closer to the upper end of the stock's price range. Also, stochastics are made up of two lines called the %K and %D line. The first line we'll go over is the %K line. The %K line has this formula where C is the latest close, L14 is the lowest low of the past 14 trading days, and H14 is the highest high of the past 14 trading days. 80 and above is the top range, while 20 and under is the bottom range. The next line is called %D. There are two types of %D lines. The fast stochastics is the 3-period moving average of the %K line. The slow stochastics or the smooth stochastics takes another 3-period moving average of the %D line. This line is less volatile and more reliable than the fast stochastic line. From this alone, we can say that the %K line is faster than the %D line. Let's now move away from the introduction and into how to read stochastics. In overbought or oversold territories, the divergence between the %D line and the price of the stock is a major signal. A bullish divergence is when the %D line is under 20 and forms two higher lows when price moves lower. As you can see, this concept is basically the same as the one introduced in the RSI. A bearish divergence is when the %D line is over 80 and forms two lower highs while price moves higher. The buy or sell signal is when the %K line crosses the %D line. Let's look at an example. Here we see SPY on the daily time frame. The blue line is the %K line, while the orange line is the %D line. Here we see the %K line cross over the %D line in overbought territory. This causes price to drop. Here is another instance of when %K line crosses over the %D line in overbought territory, and we once again see a price drop. In this instance, we see another %K and %D crossover, and although it's a small dip, we do indeed see a small drop in price. This is when the %K and %D cross over in oversold territory. The price action that follows after this is a pump to the upside. Likewise can be said here when we see another crossover. This causes another price increase. This area provides another %K and %D crossover. Although it's not as big as the previous two examples, we do indeed see a push to the upside. At the time of recording this video, we see that we are almost at overbought territories. The sell signal will be when the %K and %D crosses over in overbought territory, and this is when we will sell our longs. Now that we looked at two popular oscillators and know how effective they can be, we must also remember that they are not stronger than the trend. As mentioned below, a strong trend can keep things overbought or oversold for a long time. Therefore, in an uptrend, you should only buy when the market is oversold or buy when the oscillator is back above the midpoint. In a downtrend, you should sell short when the market is overbought or sell short when the oscillator is back below the midpoint. The final topic we'll be going over is how oscillators act in a sideways market. So in a sideways market, oscillators mimic price very closely. However, when price eventually breaks out, the oscillator is already overbought in an uptrend or oversold in a downtrend. So this brings up the question if I should buy when the oscillator rating is already overbought or oversold. Many analysts say yes, at the beginning stages of a trend, oscillators are not really important and things can get overextended for a while. Oscillators only start playing a bigger role towards the later stages of a trend. Well, that's it for this video. I hope everyone learned as much as I did reading a book, as that is the whole point of this channel. In this video, I talked about two popular oscillators, the RSI and Stochastics. The next video, we will be talking about MACD and other concepts on oscillators. So if you don't want to miss out on those topics, please subscribe to the channel. If you enjoyed this video and felt like you learned something new, like this video as it really supports the channel. If you have any questions, leave a comment below and I'll try my best to answer all the questions. Well, this is Books of the Stock Market, and I'll see you guys next Wednesday at 3 p.m. Central Time. Thanks.